Good morning and welcome to the final week of May. It's 8:03 in Hong Kong on Monday the 25th of May. This is Money Talk on Radio 3 with me, Peter Lewis. Hong Kong stocks have plunged in their biggest one-day fall in almost 5 years after China said it will introduce national security law in the territory. The White House said on Sunday that the US will likely impose sanctions on China if the law is enacted. China's National People's Congress has declined to set a GDP target for the first time. Premier Li Keqiang said the pandemic has not come to an end yet and the country must redouble efforts to minimise the losses resulting from the virus. He also pledged to implement the Phase 1 trade deal agreed with the US. President Xi Jinping said he won't let China's economy return to its days as a planned economy. He told delegates at the Two Sessions meeting that the country has strengths that will allow it to recover after the COVID-19 pandemic. He also pledged to defend globalisation and reject protectionism. On today's Money Talk, we're joined by Michelle Lam from Societe Generale and Steve Wang at CITIC CLSA. With a view from mainland China is Shanghai-based independent economist Andy Shi. The concerns over worsening US-China relations offset some of the positive sentiment generated last week by the world's biggest central banks, saying they had more measures in reserve to fight the economic fallout from the coronavirus. Investors in Hong Kong took fright and rushed for the exits after Beijing said it will impose national security laws on the territory. The Hang Seng Index plunged 1,350 points, or 5.6%, its worst daily performance in almost 5 years. All 50 members of the gauge fell. The MSCI Hong Kong fared even worse, crashing almost 7%. Property developers and banks led the declines. The Hang Seng Properties Index tumbled almost 8%. And on the mainland, the Shanghai Composite Index fell 1.9% and the Chinex in Shenzhen was down 2.5%. I tell you what, we have on the phone, we have Andy Shi, who's an independent economist. He's based on the mainland. Very good morning to you, Andy.
Good morning.
Just get your thoughts on what's happening in Hong Kong. Do you see from the mainland, how much do you see pressure now building on Hong Kong, and in particular Hong Kong's status as an international financial centre? How much do you think China will be very keen to protect that?
Well, I think that Hong Kong has been an offshore financial center, and it's kind of through this unusual structure like a red chip or H-share. It's not usually it's not like New York to the U.S. or London to the U.K. It's really its existence is due to China's exchange rate and the current account that are still kind of not flexible. So I think that offshore fundraising is been declining for quite a while, and besides, this is a small thing for political consideration. I think that for Beijing, this is not such a big deal, and they are very much focused on politics, focused on what they think is a threat to the regime.
I mean, that's the risk also is to our economy, isn't it, as well? I mean, we already saw those figures. Hong Kong's economy shrank 8.9% in the first quarter after a 3% decline the last quarter, the last quarter of last year. What are the economic impacts of this, particularly if protests build up again and we're already in recession?
I think that Hong Kong's economy has been in trouble for a long time. Hong Kong's economy was based on capital inflow, mostly from China, speculating in stocks and or properties, and then was based on Hong Kong people borrowing money to buy properties at the highest price in the world. So I think that was fragile to begin with. I think that now we are seeing the possibility of a collapsing property market, and and how it would affect the banking system. I think certainly things could get worse, but it's really about the property market. Hong Kong's economy is not independent; it's a service sector-based economy, and it doesn't really make many things. So I think it's really about property. And the Hong Kong government and the property developers are always been kind of nurturing these things, engaging in propaganda why the property price will always go up. I think that maybe people will give up this time.
Okay. Andy, let me ask you, turn our attention to the mainland. We had the National People's Congress and that China declined to set a gross domestic product target for the first time since it began publishing GDP figures in 1990. What do you make of that? Was that the right decision? Was it a sensible decision to take, not publishing a target?
Well, it doesn't make sense anymore because if you set a very low target, it's very discouraging. Now, if you set a high target, it obviously is not going to be true. You're just asking statisticians to make up numbers. So I think that doesn't make sense anymore. China's economy has been slowing for like a long time, 5 years ago. And it's not to the reason that a lot of people are saying, oh, China's mature and so forth. China's per capita income is $10,000. It's not that high. So it's slowed down because the government has chosen to put its priority on increasing social control, ensuring the longevity of the regime. So obviously you would sacrifice some efficiency, like dynamic private enterprise, because all the government wants to make sure that every company listens to the government. So in the last 5 years, the priority is to put the government on top of the market, make sure everybody understands that politics is about profit. So that's what's been going on. So I don't think the economy is that important anymore. China's labor force is shrinking. The government is talking about creating 9 million jobs. It means nothing because the labor pool is shrinking. Why do you need to create new jobs? So it's a very different situation.
If there's not going to be a GDP target, what do the authorities focus on instead? What are their priorities for China? Is it more economic stimulus? Is that going to be the focus?
No. The target, the priority is financial stability. The shadow banking system is being retracted and contracting very rapidly for quite a while because of the slowing economy and and also the people unwilling to put money into the shadow banking system. So and now the government is facing the choice of letting business go bust or you bring the shadow banking system into the balance sheet. What we have seen so far is like more and more credit is going back to the banking system. So you're seeing kind of a banking system credit growth is pretty high, but you don't see that in the real economy. Nobody is investing. Investment is very weak. So it's really using the banking system to ensure financial stability.
And how stable is the banking system then? I mean, we noticed that the government wants them to lend even more to SMEs. Are the banks in a position to be able to do it?
Well, banking system is about liquidity, and liquidity is due to two factors. One is a balance of payment. The other is the fear factor related to capital adequacy. In the case of China, both are under control. China has trade surplus and current account surplus. China doesn't allow capital flight. And the second is that the financial system is owned by the government. So the capital is only notional. It doesn't mean anything. It's really about the government. So China is a country. It has really one balance sheet. It's the government's balance sheet. And so the reason why that the financial system is stable for now, but I kind of don't think that the government wants to increase debt a lot. What's the point, right? Are you trying to get a growth going? And it's a lost cause anyway. Why would you want to risk financial instability? I think this is really the credit growth is really about keeping companies afloat. Okay. So the long-term consequence is that we are going to have a lot more zombie companies.
Okay, We're running out of time. Well, thank you both very much. Sadly, we've run out of time, but great discussion. We heard Andy Shi, who's an independent economist based up in Shanghai.
567 AM, Radio 3.
You're listening to Money Talk on RTHK Radio 3.